And as the bull market progresses, they'll use more and more leverage, and in the end, they're trying to use just absolute leverage to the eyeballs when the thing rolls over. And this just screams it to me. They usually blow themselves up in the end because they've looked in the rear view mirror. Every issue before was they didn't use enough leverage because it's just got better and better. And so, yeah, I kind of feel this is just screams like kind of the tide's turned and a lot of people are going to get carried out.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a dynamic discussion lined up and are fortunate to have with us Fergus Cullen, otherwise known as Ferg. Ferg is a full-time trader for 8 years now. He focuses on the economy, markets, metals, and energy sectors. He shares his research on his Substack, which can be found at traderferg.substack.com. Ferg, thank you so much for joining us today.
Thank you for having me on, Gary. It's a pleasure to be here.
All right, well, let's begin with what happened in the markets this past Monday. Everything got pummeled. The Dow was down 1,000 points. NASDAQ, gold, commodities, everything was down. Bitcoin was down about 6,000. Since then, we've seen the markets rebound. Many are saying it was the yen carry trade. Others are giving other varying reasons. What do you think happened here, and where do you see the market headed over the next few months?
Yeah, sure. So, I've read a lot of smart people's takes on the yen carry trade, and I always think you can't comment too much on something that you never mentioned before it happened. So it's always like this sort of hindsight analysis. But what the yen carry trade screams to me is it's just an obvious sort of end of we've had the sort of the last decade of free money, and you can take it back even further if you want than that. And I think it was Druckenmiller said, like, if people do stupid things and if you give them free money for a decade, they'll do really stupid things. And with the yen carry, it was an obvious thing where you could just use use a yen to buy your favorite asset and really take home a great return. Granted, the yen remained stable and didn't strengthen, and so I've got some friends that think a lot of it went into some pretty crazy places, and I think we're going to find out some of that over the coming weeks. I'm not sure if it's over. I've got no insight at all. I wasn't even that aware of it, so take any comments I have with a pinch of salt. But how much of it found its way into the likes of crypto, the likes of Nvidia, the likes of it really reminds me of property. Like I started in this game in sort of property management and development, and it always reminds me, like, a lot of property developers start with like a small residential development, and they'll be quite kind of safe on the leverage side, and then that'll go well. And as the bull market progresses, they'll use more and more leverage, and in the end, they're trying to use just absolute leverage to the eyeballs when the thing rolls over. And this just screams it to me. They usually blow themselves up in the end because they've looked in the rear view mirror. Every issue before was they didn't use enough leverage because it's just got better and better. And so, I kind of feel this just screams like kind of the tide's turned and a lot of people are going to get carried out that have been using more and more leverage as time's gone on. And it doesn't affect any of the trades I've really put on. I just hanging out in hated areas, and if anything, it's a lot more volatility, and just have to stomach it and keep doing what I've been doing, just hanging out in all sorts of commodities and post and stuff that's gone bankrupt and coming out the other side again.
So we're definitely going to get into those hated areas that you just mentioned here. But Ferg, do you anticipate the fiscal dominance playbook continuing post-election, regardless of who the next president is? And what consequences, if any, do you see coming from this type of spending? And in what time frame would these consequences start to show up?
Yeah, 100%. Well, I've kind of got like a cartoon that I've wanted to use. It's a cow, and it's looking like it's got two choices, and both lead to the slaughterhouse. And I just kind of crossed off the slaughterhouse and put inflation. And it's like whoever you get, it's the same playbook essentially. They're all, whether it's Trump, whether it's Camilla, like whoever, it's going to be big infrastructure spending and going to end up in the same spot. So I I don't really see any different in which person's in charge yet. You can argue different, like maybe the pushing green energy is a bit more inflationary. Maybe what Trump's going to do, pushing the oil and gas production could help a bit, but overall it's hitting the same place. And kind of when you run the numbers, I've always said sort of all roads lead to the Fed's balance sheet blowing out. Like it just, there's no way this makes, like you've really got three options when it comes to, you can default, which you don't need to when you can print. You can have austerity, but anything that could bring things into balance, they can't touch really. Can't touch entitlements, can't touch military spending. And that leaves you with the same old playbook, which is just inflate the debt away. And that's where we're going to end up. It's going to be some form of yield control, and they're going to have to bring it down. It's kind of the 1930s, 1940s playbook where sort of debt to GDP will go from 120 and they'll bring it all the way down to 40 odd percent. It's like kind of, I follow Luke Groman, lean on Louis Vincent Garve, a lot of their work. I'm not much of a macro forecaster myself. I just listen to enough smart people and kind of decide when I hear enough people that I respect coming to the same conclusion. I was like, that sounds good. And it also matches with a lot of the stuff I like to be in anyway. It's just an extra tailwind. If I'm buying something that's on 2 times cash flow and I like the sector fundamentals and the supply demand, the fact that there's going to be higher inflation for longer just feeds into the thesis.
Is there consequences that you see coming from, basically the fiscal dominance playbook? Is there something that could go wrong here?
Yeah, I guess it's just a lot of stuff that can break. Yeah, as we're finding out now. Like it's the I was just reading Paulo Macro's Substack before. I lean on people smarter than me. Like with all the it's like we talked about before. I don't really like to dive into what whether this will be this many rate cuts or this. I like lean on smarter people than me to think what the ultimate or how to play that or even trade that is. But yeah, I see the main issues I see at the moment is just they're kind of cornered. Like anywhere they move, they break something. As we're finding out with the yen trade, right. Like even doing nothing breaks stuff because there's so much leverage, and that's the way. I just wrote a piece earlier, and I'm just sort of. I always like to use this this case study that it's named like even God would get fired as an active investor, and it just shows that people have this idea that you can be super smart and you pick the perfect stocks a few years out, and you'll have this beautiful ride to great returns. But what that study showed is even if you pick the perfect places to be, you have like a god awful drawdowns, volatility, and have a hell of a ride on the way there. And that's kind of the way I view this. Is just there's a lot of people that are going to get caught out as the tide comes in or goes out. The old Buffett saying, or they'll get caught swimming naked as the tide goes out, and there'll be a lot of volatility on the back end of it. I'm not going to pretend I can know what some of those events will be. As I said, I never mentioned the carry trade before it happened, and I honestly don't think many of the pundits did that I hear writing big posts on them now.
Well, you're so dead on with the volatility, the roller coaster ride, hanging out in the hated, areas that have been sold off, and you would think that the volatility wouldn't touch those, but they get hit so hard. So there's many metrics currently that are pointing to the economy slowing and slowing pretty quickly. What's your view on the current economy? Do you see it as slowing? Where do you see it going over the next few months?
Yeah, I like the people I respect and lean on for it. There's like half in the recession camp and half think it's like smooth sailing and it's just going to get papered over. Yeah, and so when I see that, I've got no firm view on it. Honestly, like I don't think um, and I've got no positions that reflect any view either. So if I was to say something, I wouldn't be putting it in my portfolio. So I'd prefer like just to say, yeah, I'll my kind of view from everything I've read is it'll be shallow if kind of no recession is the take, because it's just this kind of reflexive function now that money gets thrown at every problem, and so that's kind of the way I view it. That if it gets bad enough, there'll be money thrown at it, and the real game to be had, kind of going back to what I said with the Fed's balance sheet blowing out, is you just got to try and stay ahead of that. It was Luke Groman, he had this great tweet a few days ago, and someone said, like, are you saying everything's not going to be fine? And he was like, no, everything will be fine. It's just in the GFC, the Fed's balance sheet went from, I think it was 800 billion to 4.5 trillion for everything to be fine. And then whether it was, I think it was COVID, it went from, I forget the number, it tripled again, the Fed's balance sheet for everything to be fine. And if we get into issues again, who knows where it'll go for everything to be fine. And so when you understand that's the big dynamic, everyone gets caught up too much in the details. It just becomes this kind of game for how do I hunt out scarcity when I know you're going to get debased. You need to hunt out real real assets, and you want to find the scarcest, the ones with the highest replacement cost, the most energy intensive assets, when you understand that's the big game.
That's a great line right there. Hunt scarcity when the currency is being debased. So you mentioned Luke Groman. Ferg, he wrote this. No investor alive has seen a U.S. slowdown or recession with 122% U.S. debt to GDP, 7% deficit to GDP, and 80% net international investment position to GDP. The only thing that was keeping Western governments nominally solvent was the inflation, and that's now fading. What happens next here?
Well, yeah, I think one of my favorite lines from him is everyone misunderstands that the US's main export for a long time now has been debt. Like the Saudi Arabia, US is a Saudi Arabia of debt. And the problem is there's no big buyer. Like the Saudis have pretty much said, like, we're not going to recycle into US debt. The Chinese have said, no, thanks. It's a lot of it's been on the back of, it was already happening prior. So it's not entirely on the back of the seizing of the Russian assets, but that really pretty much drew a line in the sand that, like, anyone that had an iffy relationship with the US or could run into issues, like, China's not going to store money in treasuries anymore. Saudi's not going to store money in treasuries, and they need to sell an awful lot of them moving forward. And so it's kind of obvious that they're going to have to buy them themselves. And I'm sounding like a broken record now. I just keep coming back to the Fed's going to be the buyer, or maybe it forces it onto institutions, pensions. It'll force it into everywhere it can. But ultimately, they're all going to end up mostly on the Fed's balance sheet. And once you understand that, it's just, how do you protect yourself against it?
Yeah. So you've mentioned the Fed a few times. Central banks are actually cutting rates around the world. We've seen the Bank of England, the European, Central Bank, and the Bank of Canada. They've all begun their rate cutting cycles. Are you anticipating the Fed to begin theirs soon? And how low do they take rates in this cycle, if you had to guess?
I've got no idea. Honestly, I could take a guess, but it wouldn't. No one should put any weight in it at all. Yeah.
Are you expecting them to cut rates, or are they just jawboning right now, like they have been for the last year?
I feel like they have to jawbone it because otherwise the kind of game's over. What like how you bring inflation under control is you've got to essentially get rates above inflation.
Right.
They can't do that. It's a lot of jawboning, and it's a lot of just pretending, and ultimately can't do what they need. Coming back to that whole factor again of the they can't balance the books. They when you take in the cost of the debt, you take in military spending, entitlements, it doesn't balance. And so, it's just mess.
So, Ferg, what do you see as the biggest risk currently to the markets?
Biggest risk I find is I wrote a piece a while ago, and this is kind of leaning on something Mike Green wrote a long time ago, which always stuck with me. It was this sort of how does passive kind of what passive is created, how does it unwind? And that's just the understanding that passive has continued to grow until it's far larger than the active component in markets. And when you consider that for every passive dollar that goes into the S&P, you're having a third of it is ending up in the Mag 7, and even more than that, what is it, 7% Apple, 6.5% Microsoft, and nearly 7 again Nvidia, or maybe a bit lower. That's just going straight into them. Same with NASDAQ, just getting poured in. If people decide that this needs to rebalance, maybe because inflation starts picking up and you want to be in something that will do better in an inflationary environment, how does that rebalance? And with the passive dominating and the active now being a lot smaller and not being able to take these positions off passive's hand, because ultimately passive is just, it's like it's a systematic buyer. Like, it doesn't care about the price. Put $1 in and it's just going to purchase regardless of the price. And when that gets flipped, like who's gonna take all the Nvidia or the Apple off the index's hands when they need to rebalance? Like, who's there? Because the remaining active investors probably over trying to get into whatever's the cause of the indexes needing to rebalance. They'll be in what's outperforming. They're not going to be hanging around taking Nvidia, Microsoft, Apple off passive's hands for a 10% down. And that's what really fascinates me, is like, could these things really go like no bid for a period, like really have huge pullbacks? Because where's that incremental buyer going to come from? And it's kind of fascinating when kind of seen it play out now. Sorry.
Is that your base case? Do you see that happening at some point?
Yeah, well, I think it inherently kind of has to, because unless you just want to keep forecasting forward, these companies keep getting bigger and bigger, and I could have a rant on why Nvidia's ultimately going to prove to be cyclical, how it's a lot of it was essentially an arms race between some of the other tech giants not wanting to be left behind in the AI, and that's kind of starting to reach the end of the runway. Like, they've spent a lot and it's not really showing up in the bottom line. Some of it was even kind of essentially like vendor financed by Nvidia, like they were helping them purchase some of the stuff. And so it's you can't really, it's just that whole idea of you can't project the stuff forward that much longer. Maybe I'm wrong, and maybe it has one more rip higher, but if you start taking this out too much further, it doesn't make sense. And so the last point of that is seen in the likes of China. I saw a recent article that Nvidia was having to mark down some of its products because it couldn't compete with some of the domestic producers. Like, there was, and so when you see that already, it just kind of reminds me. I even put it in one of my emails. It was a magazine cover, and it was from Nokia, and it was said like, Nokia, the cell phone king, who can catch him? And then there was a similar one up in Barron's. It was Nvidia, like, who can catch? No one can keep up, or some phrase like that. And it's just, whenever you see this in markets, it's not going to last.
So, so let's say that plays out at some point. Who knows when? But let's say that plays out where the Mag 7 goes no bid and they
Mm.
plummet. That'll pull down the entire market, right? Because of their
Hmm.
scale.
Yeah.
So
Yeah.
you see a significant market. I don't want to speak for you. I'm just trying to
Mm.
understand. So you see a significant market pullback at some point, yet at the same time, inflation picking up. Is that right?
Yeah. 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 Well, whenever inflation picks up, because some people have the idea that if you look back in an inflationary period, equities just cruise higher, and if you that is the case when the valuations have come down to levels that make sense for most people to own them in an inflationary environment. But at the start of an inflationary environment, everything that's has a high valuation gets killed because it has to then come to it. A lot of the stuff is still kind of almost predicated on the idea that you have to hunt out growth because rates are going to be low out in the future, and the way you get your returns is by some of these tech stocks, which will grow like crazy. And so, yeah, I see the valuations having to get crushed. And yeah, as I say, I don't understand how this rebalances. So a lot of volatility potentially coming down the line, I guess. But then, yeah, how much am I actually playing this? Like, I'm not playing, I'm not playing this in my portfolio other than just sticking with deep value and if anything, trying to stay out of the way of a lot of stuff that's benefited from passive flows. Some of my favorite stuff is hanging out in like hated corners in sort of Singapore exchange, Hong Kong, Norway, like just little indexes that haven't had any benefit of these massive passive flows.
So if this scenario plays out the way you believe it will,
Hmm.
isn't isn't significant job losses unavoidable?
Yeah, yeah, I guess, yeah. I wouldn't have any deep insight into it, but I'd say so.
Yeah. Okay, so you mentioned Paulo Macro earlier. He recently wrote, "We're going down very hard here until we get some plaza panic. Markets
Hmm.
stop panicking when politicians start panicking." Do you have any
Yeah.
thoughts on his comment?
I love Paulo. Yeah, he's someone I look up to because the way he navigates the market in the short term is an ability I've never had. I've always leaned on my mentors. Sort of, whenever I try and get too smart in the short term, he's like, "That's interesting, but are you gonna play that in your portfolio in any way?" And I'm like, "No," and I'm just gonna be positioned for where I think things will be in in 3 to 5 years. And yeah, regarding politicians, I think they never get ahead of this stuff. They'll just keep reacting short term to whatever's blowing up, and so it doesn't actually change anything. They're just kind of firefighters running from fire to fire. They don't proactively get in front of anything.
No.
Kind of like, yeah.
So the image in my head that I'm getting that from what you just said was skate to where the puck is going.
Mm.
So that's
Yeah.
kind of what you're doing. You plan for where you think things are going to be 3 to 5 years from now, and deal
Mm-hmm.
with the volatility until it gets there.
Yep.
Yeah,
100%.
yeah. So in a recent Substack post of yours, you stated, "Sitting in cash will be financial suicide if Project Zimbabwe really gets into gear. If you sat in cash in 2020, you're down nearly a quarter on your purchasing power as of today using government CPI. The game for the next decade
Yeah.
is keeping out in front of the Fed's balance sheet, which may well mean riding investments to silly levels because there are no cheap alternatives to protect purchasing power." Ferg, would you speak into those comments for us?
Yeah, certainly. So we'll start with is kind of obvious using that stat that you really got destroyed and will continue to get destroyed if you just think you can sit in cash. Um, Granted, there's some very smart people out there that use cash for its optionality, waiting for like big drawdowns to jump on their favorite assets. So I really respect people that have the patience to do that. it's never been my style. I just like look for value, and when it pops up, I buy it and just ride it. I'm usually pretty much fully invested, and if the value gap gets too big, as it recently did in the post I just wrote, then I'll jump from something to something else. And sometimes it's not great timing. I take a bit of a loss on something to get into something else. But yeah, that's the way I'm kind of I come at it regarding writing stuff to silly valuations. That was actually from reading a book. I'm forgetting the name of the book, and it was observations from the Weimar Republic, and it was that some of the like smarter investors at the time had actually got ruined by getting into stuff that they knew well, and then the valuation started rising, and they saw such silly valuations that they were like, "This is just ridiculous. I'm going to have to sell out," not understanding that that was like the only way to kind of hang in there and protect their purchasing power. And so at some point, you've got to ride stuff to silly valuations if there's no alternative and you can't sit in cash. And that was another lesson from my mentor, Brad, as well, is like a lot of what I talk about is always predicated on there being another kind of hated sector I can rotate. If uranium gets crazy, I'll jump into oil field services. If they take off, then I might end up in thermal coal. Like there's sort of an ability to rebalance. But he kind of reminded me, and it was when he was managing money in the lead up to the GFC. He said there was nowhere cheap. There was nowhere to hide. He had to kind of go to cash then, which was fine then because inflation, so it wasn't running that hot, and so he could just sit in cash, but might not have that luxury this time around. And that's why I kind of have that Weimar Republic sort of example in the back of the head, that you just sort of say, oh, this is silly, I'm getting out. Well, then what's the alternative? Which is also kind of the name of the piece I just wrote, like kind of what's the alternative to getting out of this? Or is there something more attractive? Otherwise you kind of might have to just sit in it and watch it go to crazy levels.
Yeah, it's amazing. In fiscal dominance, a currency will fall versus the commodity sector over time. So is it better to hoard commodities and ride the ups and downs, the volatility, rather than being in US dollar or treasuries, since they're just going to only fall versus commodities anyway?
Yeah, 100%. I'm all in commodities. Yeah, you're speaking to the converted in that. Yeah, my entire out view and my pretty much all my net worth is just trying to work out which is going to be the best expression within the commodity space, and that's kind of what I spend all my time doing, is trying to work out. Like, I think pretty much any commodity will outperform from this point forward, and I just want to be in the handful that I think outperform within the commodity space itself.
So what's the we'll call it the termination point, the point where that part of the cycle, the commodities outperforming, when that's over? Is it when they finally get debt to GDP down to 40%?
Yeah, well, maybe it's before that. Maybe a whole lot of the supply problems are solved as well. I don't know, if you look at the past cycles, it could be treasuries are just yielding something crazy, and yeah, there's been an awful lot of money poured into commodities, and so it starts to make sense to kind of shift across. If you look at like historically how it worked. But yeah, I think that's a long way off, as kind of keep a close eye on all the supply demand and everything I'm looking at, and not even close to balancing. And I think it was Jeff Curry. He had a great observation that it usually takes at least sort of 12 years. First, you've got to have the allocators see the sector start outperforming. That usually takes 3 years before they're comfortable allocating money. And then you've got another sort of 6 years of the capex being put to work. And then the last sort of 3 years of them outperforming before it kind of rolls over. And that's generally a commodity sort of commodity cycle in itself. So I always found that interesting.
So based on that, I mean, simple math, are we looking mid 2030s? Are we in the first inning here, second inning?
Yeah, I'd say so. But it depends on which commodity as well. Some have obviously attract more capital up front. Some are more capital starved due to a whole lot of factors, kind of like the whole transition has capital starved a lot of some sectors more than others. But yeah, as a whole, there's been underinvestment across the whole commodity space, really.
Yeah. Yeah, I think Larry McDonald has said that over the last 10 years, it's about $3 trillion shortfall.
Yeah, well, which is interesting as well when you even use those numbers. Kind of going back to what we just talked about, inflation. I've used that before. If it was 3 trillion in 2020, you've got to add another 20%, 25% by now.
Sure.
Yeah, and it just keeps adding up. Yeah,
So
and
for
also if the energy
sorry, go
side
ahead.
runs as well. Sorry, I was just going to say the energy. If that side runs, that really feeds into inflation as well, and so that's where it could get quite crazy.
So for in this fiscal dominance project Zimbabwe scenario that is being laid out here, where does gold, silver, copper, the S&P, Nasdaq, like how high do they go? I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. Just like this one, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive this free gift on us. Also, I'm positive that you've enjoyed the conversation with Ferg as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video.